Welcome to the Startup of the Year podcast, where each episode we showcase exciting new companies from around the world. This podcast is produced by Established, creators of the Startup of the Year program. Established is focused on helping organizations with their innovation, startup, and communication strategies. Thank you to our podcast sponsor, Silicon Valley Bank.
Hello, everybody. It's Frank Gruber, the host of the Startup of the Year podcast. We're back again with another episode. Today's going to be a special episode, though. We've got Rich Maloy, one of our co-hosts, and he's going to be talking to a couple of experts on alternative capital opportunities and alternative capital structures. So basically looking at all the options other than venture capital. We've got two guests. We've got Thor Culverhouse, the CEO of Lighter Capital, and John Willard, Managing Director of Silicon Valley Bank. So let's listen in as Rich Maloy talks to these experts. Take it away, Rich.
Yeah, thanks, guys, both of you for being here. Thor, let's, would love to hear a little bit about you and your background and Lighter Capital. So please do share. Tell us.
Thanks, Rich. So, yeah, I'm the CEO of Lighter Capital. I've been there for just about 3 months, so just joined the company. Lighter Capital provides alternative tech financing, principally debt structures, to early stage venture-backed or soon-to-be venture-backed companies. So we typically get involved with organizations that are sort of post-angel and pre-sort of Series A venture funding companies. I came from this world, so I was a 3-time CEO before I got to Lighter, raised a lot of capital, and really had a lot of appreciation for what Lighter was accomplishing.
Excellent. And you're up in Seattle now, but before Seattle, you were down here in Colorado.
That's right. I ran a company here in Seattle for about 6 years. It's still an ongoing concern. And then I ran a couple of companies in Denver, Colorado.
That's great. Yeah. And John, thank you for joining us. So John, I'd love to hear a little bit about your background and Silicon Valley Bank.
Sure. So, So John Willard, and I've been with Silicon Valley Bank for the last 23 years. And I've been mainly in the technology banking and venture lending area of the bank, which entailed kind of a lot of different experiences across different product groups. The main sectors I focused on were software and the internet, and those evolved quite a bit over the last couple cycles of the economy. And so I've moved my way across different asset-based lending in through research and development. And I am presently a managing director in managing digital partnerships in our digital acquisition area of the bank. And Silicon Valley Bank is about a 35-year-old company. We focus on a wide range of banking services to companies of all sizes and innovation centers around the world. So we have offices across the United States and in Europe, Canada, and China. And we really focus across really the primary technology sectors of innovation through hardware, software, life science, private equity, energy resource innovation, and premium wine. And we also serve the investors that really support these companies' innovation. So we have a practice that supports the venture capital innovation. So that is mainly my journey there. It's been 23 years. I worked a little bit of time before that in Bank of America, but kind of the journey's been at Silicon Valley Bank.
That's fantastic. And SVB has a very strong presence out here in Colorado. And I'm not just saying this because SVB is a sponsor of the podcast, and we're grateful for that. But seriously, the reputation out here of SVB is really stellar. The people that have represented the Silicon Valley Bank in the early stage banking business have all been stellar people that have done a great job of putting the community first, figuring out how do I give to the community, and with asks or business as a something that when you're ready, we're here for you. And that sort of attitude just it goes really far out here in Colorado. So we appreciate SVB as a community partner, as a Coloradan, I could say that, and also for the Startup of the Year podcast. So thank you for that.
Fantastic to hear.
Yeah. So let's kick it off. Let's get down to details here, man. I've seen more and more about revenue-based financing in the last couple of years than ever. And Lighter's been around for a while, and you guys have been doing this for a while. And Thor, even though you're new as the CEO, I'm sure you have some you have some great depth of knowledge about this. And so I'd love for you to just start out by telling us what is revenue-based financing.
So revenue-based financing is really effectively a term loan, but the way the payment stream is structured is that the payment is fundamentally a percentage of your monthly MRR. So, principally we invest in tech-enabled MRR-based businesses, early stage companies, as they're growing and they're moving up and to the right. Still being early in nature, they tend to have some variability in their monthly recurring revenue stream as they're building momentum. And so revenue-based financing is actually rather unique and supportive of that entrepreneur because the payment stream can effectively fluctuate based on your monthly recurring revenue. So if you tend to have a flatter flatter month compared to the previous month, or you have a one where you're accelerating a little bit faster, that payment stream fluctuates as your performance fluctuates. So it's unique in structure, but it's again very supportive of that type of business and people that are trying to grow. Now we do have other loans, traditional term loans and lines of credit for classic working capital, but that revenue-based financing is really the core piece of our business. And so, and maybe just a few words, Rich, on exactly where we play in that space. And so we target companies that are either somewhat dilution sensitive and their capital requirements aren't as big as compared to some other hyper growth companies, or if companies are just earlier in their life cycle and haven't crossed all the T's and checked the boxes for that initial Series A equity investment. So their options are often very limited. It's hard, to continue to tap either the angel network, or very often, entrepreneurs are flywheeling some of these companies on their own. Or if they go to, a classic bank, sometimes they require some sort of personal guarantee. We're different in that structure. So we don't require warrants, and so there's literally no dilution. And there's no personal guarantee. And so we've got a data science team and a crack underwriting team where we basically price and size the loan on the underlying fundamentals of the growth of that company. What's the churn? What's the burn? Path to profitability? Things of that nature, we look at, and then we price and structure the loan accordingly.
That's amazing. I love that. I mean, I absolutely love that. That, the non-dilutive capital based off of the business that you're doing, and you don't need to be profitable, right?
That's right. I mean, obviously you got to be generating revenue, and we have a sweet spot that, we typically target companies that are doing at least 15K MRR, and we price loans as, small as $50,000. Our sweet spot tends to be in the kind of 300 to 500 range. We'll go all the way up to 3 million if we need to, if it's a more, successful company. And frankly, you pointed it out earlier, and it was a great point. We've been in this space for a long time. So we've been around for about 9 years. We've done over 600 loans. We've got over 350 customers. So many of our customers actually will come back, either restructure those loans or they like that trajectory. They like that cost of capital. And cost of capital, by the way, is a very important consideration here. If you are providing, giving up warrants or, giving up equity too early in that growth curve, if you really look at the calculation on what does that ultimately cost you, very often a debt structure like ours is considerably cheaper in the long run.
Yeah, absolutely. And it gives you that fuel as a startup that you need to get to that next stage by leveraging. You have to leverage something if you're going to take out a loan. And so
that's right. And as I mentioned kind of in the introduction, I've been a 3-time CEO before I got here, and I've done some super early stage stuff. I've done some later growth stuff. And, I think all entrepreneurs, if they're in this game long enough, it's a spectrum of capital. You're not going to go to one source all the time. Very often you're going to start with some sort of seed angel kind of fuel, maybe your own. A structure like lighter capital is perfect for those earlier stage companies. You may graduate to, more kind of a, venture debt structure that John may talk about in a little bit. Ultimately, maybe venture. And then ultimately maybe private equity or eventually sort of IPO. But there's multiple ways to finance your company. And I think understanding which one is most appropriate for the stage of the company is super important to understand.
Yeah, absolutely. Absolutely. Wonderful. And let's shift gears and talk John, let's talk a little bit about SVB and the opportunity that SVB provides to provide venture debt, and the direction that you all are going with that.
Sure. So traditionally, Silicon Valley Bank has focused, like all venture debt industry in general, has wanted to have an equity sponsor or a venture capitalist in the deal. And that's largely true today. Really, our platform, our credit platform, is really structured to start at the Series A and then move on and grow with companies as they progress and raise subsequent equity, all the way through public offerings, and really indefinitely. Now our platform can support that, and I think that has served us really well in general, our growth. And where we are today is we're looking at different ways we can continue to serve our customer base, even in the pre-seed. And we're making significant investments in our digital experiences for clients. We want to engage with our client base much earlier. And historically, we've been able to provide selective amounts of seed debt, but the criteria has to be a bit more narrow in scope because of the ability to really have a way to repay the loan, have repayment sources in the absence of a traditional or institutional VC. So it's been present, but we want to be able to address the needs of the pre-Series A. And in looking over our client base, we want to address, and where Lighter fits in, is we have wanted to address really a segment of our client base that there's an opportunity with the higher quality. So think of the companies in pre-Series A that have recurring revenue that potentially are electing not to raise equity or being more strategic in their timing. So we have this group of companies, both our client base and as well as in the industry, that have our post-revenue, post-product, their seed or angel funded to sometimes a large degree. The growth-oriented working capital needs. So it's not to fund losses, but it's really to help them strategically grow. And we want to be able to play a greater part in the helping to arrange the capitalization of the company. So work with them as they're raising equity alongside them, provide the appropriate levels of debt and the right structure. And so that really brought us closer to aligned with what Lighter Capital's doing, and that the recurring revenue product, being a term loan in essence, but with a structured repayment, really aligns with our traditional growth capital product, which in the end is just a much larger term loan that has a certain draw period and repayment terms, but they're largely coupled with equity, and they provide benefits of minimizing the amount that companies have to raise so that they can save in dilution, or they provide them with insurance policies at the end of their cash cycle when they're running low on cash. They draw on the venture debt to bridge them to the equity round. So I think the structure that Lighter provides in their loans is in essence has the same impact or benefit to entrepreneurs. It's just at a much earlier stage, and they can do it through their technology and their underwriting and the type of revenue models that they're electing to lend to. That really addresses an underserved part of our client base that we want to engage with more. So it really accomplishes a couple things. It allows us to engage with that customer base sooner and give them value with a trusted partner, and allows us to start building a mutual relationship with a trusted partner with that entrepreneur, so that when the time comes that they've reached that range of raising Series A, we've already established a much deeper relationship. So we're serving our client base much better, but also building stronger relationships with companies like Lighter earlier on in our lending cycle.
Yeah, that totally makes sense because, and Thor, this comes back to the revenue-based financing is that, so SVB can make that introduction to Lighter. A startup can get that funding that they need, but revenue-based financing is not just it's not the last round that you raise, right? It could be, but if you want to go on and raise an A or a B after that, that's something that fits in very well with the products that you offer.
No, that's exactly right. I mean, John hit the nail on the head, and I sort of alluded to this earlier in that there's a continuum of capital that's available on the market, and there's also a continuum of capital that's appropriate, kind of depending on the growth stage of the company, the rate at which they're growing, and and each company very often has different capital needs. And so what I love about the partnership between Lighter Capital and Silicon Valley Bank is that, we can work with that company kind of cradle to grave, if you will. So early on, revenue-based financing, pure debt structure, no dilution is an appropriate vehicle very often, again, for those earlier stage companies. As they grow up and have bigger requirements, that equity in combination with some venture debt and the associated banking structure and banking facility that Silicon Valley banks is an obvious next step. It's really kind of a graduation. And since we're longtime partners and we have a national reach and soon going international, we can serve a broad set of customers collectively. And we know their team well, and we work quite nicely together. We know each other's offerings. And so that complementary nature and the breadth of the capital structure is a great place and a great complement to many entrepreneurs.
Yeah, absolutely. Absolutely. No, it's the, as you said, the continuum of capital. I love that. And so as you're raising your seed or your angel round, get to the point for the revenue-based financing. And then after that, you move to, if you need to, you move to the next round of capital, and having that partnership, whether it's SVB or Lighter or both, will support the entrepreneurs on their journey, which entrepreneurship is not easy. And we're all out there, all of us, all three of us on this podcast are all out there in the business of supporting entrepreneurs on that journey.
Maybe I'll add one more aspect maybe for the listeners about kind of the perspective of the relationship and long-term outlook when you're starting out as a company and looking at who are some of the more key relationships you want to establish early on. And having deeper relationships in general is important, but I think having one with your credit providers, whether it's SVB or Lighter or anyone else, some things to keep in mind and how we've structured this partnership is that it's a very seamless and founder-friendly transition as the company grows and their needs kind of sunset from a borrowing need from Lighter, and they move on to maybe a more of a venture-backed need into like where it might fit into the range of Silicon Valley Bank. Having collaboration between creditors of any creditors is very important, and it's things I've seen in the market where those are things that have unnecessarily, I think, impacted startups where creditors, that the handoff can be a very risky time for a startup, and that if you have an existing loan or you're stepping out of a loan into, you raise your round into a larger facility, having good continuity. And we have an intercreditor arrangement in place so that we could structure more optionality. So if a Lighter loan doesn't need to be retired necessarily if they take a loan with SVB, we just have intercreditor arrangements. We can discuss it to the benefit of the startup. So you're not taking Series A dollars and paying off debt, which is very expensive to an entrepreneur. And also, we haven't been through a credit cycle in a number of years, and I've been through a few at the bank now. And I think one thing to appreciate when you have creditors is that when you have downturns, depending on how you construct your team, so to speak, or your debt capital providers, a lot of cooperation sometimes wanes in difficult credit markets, economic and even venture cycles. So having a difficult downturn, often creditors don't always cooperate, and often the one in the middle is the company, the borrower, right or wrong. So thinking about the team that you build early and building good relationships, and then thinking strategically down how do you have a longer term outlook, and how that team you build can have a bigger effect, especially if they have capacity to grow with you. So that's what we've constructed in mind. That's why Lighter was a fantastic fit with us, because their market focus and their customer focus aligns with ours, and it should be a seamless transition for companies as they move up.
That's great. The relationship building can't be understated, and maybe I'm biased, but John, sounds like we're in the same mindset here, right? Is that to me, you have to constantly be building these relationships, because when you need it, when you need somebody in your corner, if you don't have that relationship in place, it's too late to get that. But if you have that relationship and you have that trust built, and that works on both sides, not just for the for the startups talking to the bankers, but to the other way around, to the bankers talking to the startups. But you have to have that relationship in place, because when things do turn south, if you have somebody in your corner that understands and knows where you've been, then they have that data on you, right?
Correct. It's very important to have consistent, you rely on a partner for consistency. And when you have relationships early on, if you're focused centeredly on just costs and transaction, that's probably not the best approach, or where relationships and really building those enduring. And over time, then you could focus on optimizing and lowering costs. But really, entrepreneurs is greatest when you first start out. So having a predictable partner, whoever that party is I can't state the importance of that, because as startups, you really need to have the least amount of surprises as possible, and you really don't want those coming from those that have capital or withhold capital from you. So that's why you pick good investors, and then also equally, credit providers are just as critical.
Yeah, absolutely. Thor, what's your experience been in the, as CEO of multiple stage companies with that? You've seen some downturns as well. I mean, I'd love to get your perspective on, how capital has affected, or access or lack of access to capital has affected your businesses in the past.
Yeah, well, I'm really fortunate for the timing of providing an example, but many of us that are running companies and are in a venture-backed company, there's obviously there's usually some predictable burn cycle that you are running against while you're trying to get your top line up. You typically have a higher expense ratio for some period of time. Yeah. Hopefully it's predictable. And we were running one such that we needed to raise capital 2 years out. And this was a company that I was running in Denver, by the way. And I had predicted to raise capital in September of 2008, not knowing what was going to happen in September of 2008. And we had multiple contracts on the table. The company fundamentally was in great shape. It wasn't an MRR business per se, but nonetheless, we hit that financial downturn. And not only did, obviously the economy slow, many of our customers retracted, but also at the same time, many of the VCs at the table didn't lose interest in the overall fundamentals of our business, but because of their LPs, they also sort of recoiled. So here I was sitting with a company that had, a reasonable burn and, had some debt on the sideline with a particular tech bank. And I literally had to go back to, our inside investors, as well as, our tech bank at the time. And we fundamentally had to restructure, what that entire thing looked like. We had to recap the company, put in some additional, venture money from our existing investors. We had to work with the bank. And this is the salient point here, is that we had to work with the bank, who was our partner, to make sure that they understood the trajectory we were on, the fundamentals that we were moving around in order to weather the storm, if you will. And to John's very important point, none of that would have happened if we didn't have a deep relationship with the bank and the investors at the time. They all knew me at that point in time. I'd been there for about 4 years. They had a clear understanding of the unit economics and how we were going to pull the nose up on the plane, and they stuck with us. But none of that would have happened if not for some deep relationships that were learned along the way.
Yeah, wow, that's fantastic. And as we're all
by the way, there was some. Sorry to interrupt. There was some good news there that we ultimately did weather that storm. And 2 years later, we ended up selling the company to HP Software, and everybody who stuck with us in that adventure, were handsomely rewarded, because it ended up being, quite a nice multiple. And that wouldn't have happened if people didn't buckle down and start to count on each other and kind of restructure our financing approach and make it through that challenge.
Yeah, fantastic. That's awesome. We're in a world that, the way that the startup economy and the startup markets have grown so much is incredible. And almost to the point that, it really is to the point where there are some well understood metrics around what you're looking for, at Lighter for what makes a good investment. And you touched on this a little bit earlier on, but I want to dig in on this on the tech-driven process on investing in tech companies, and would love to hear a little bit about how that works for you.
Sure. So first of all, we principally target companies that have monthly recurring revenue and low churn. Although most newer early stage company have some degree of churn, may not necessarily be profitable, but it's really understanding that customer acquisition cost. It's understanding exactly how predictable that burn and churn is, so that we can plot an expectation or an estimate of when the company is ultimately going to be profitable. So we like that MRR business because if they do have low churn and there's a sticky business, all of those customers have some predictable tail to the relationship, and therefore the revenue stream and path to profitability is easier to predict versus companies that may be structured differently. So we like that space a lot. Mm-hmm. And obviously, given the fact that it's a tech economy, we continue to believe that that's a place to provide our investors a great return. So that's kind of one angle. The other part of it is we use technology as well to understand exactly who to invest in. So we have a data science team coupled with our underwriting team, and we collect a lot of information from these prospective borrowers through an application process and an underwriting process, and we work very closely. It's not a 5-minute journey. We try to get through it pretty quickly. In fact, we pride ourselves on how quickly we can underwrite these companies because we use some of these methodologies. But fundamentally, we're able to use our data science and underwriting team to take a look at those core fundamentals and decide who we believe are the most likely to continue on a growth trajectory that we believe is worthy of making that debt placement. And then obviously we keep a track of it, and we continue to work with the entrepreneur and the company to make sure that they're continuing to grow at the rate at which they predict. And if things do go bump in the night, we work through that with our companies as any good partner would. So again, we love the space. We love the MRR sort of business, and we apply our own set of technology to make sure we're investing in the right companies.
I love it. Yeah. That's not quite eating your own dog food, but almost.
Yeah, close. Yeah.
And and you mentioned also about the expanding locations. And so where have you been? So Lighter's based in Seattle, has a national reach. Are you seeing your customer base shift and change?
Well, we are. Principally because we're opening up the aperture and where we decide to work. So we're partnered with Silicon Valley Bank. We're getting ready to move into Canada. We believe Canada's a great economy, a smaller economy than ours. But if you look at the competition from our perspective, providing RBF type loans to MRR companies in Canada, it's a great match. And again, we're going to partner with Silicon Valley Bank there. We're also moving into Australia, very likely in Q2. And then longer term, we're also targeting the UK. Probably longer term for me, by the way, is not that long. It's only like Q3 or Q4 kind of time frame. Okay. So we think that, and there's other opportunities, Israel, there's tech hotspots around the world. And, this concept of a SaaS type business, MRR type business is actually quite hot for all the obvious reasons. And, North America is not the only place that some of these great ideas are coming from and some of these great companies are being born out of. And so, we're going to follow those opportunities sort of wherever it takes us. So we're just this coming year, FY 2020, we're expanding our reach considerably.
Why Australia over the UK? Why make those moves in that order? Or is there some particular reason for that?
Well, we also have a similar partnership with another bank in Australia, and so it's a natural fit. But when I look at geographies like this, you kind of turn the mirror around and say, how I judge companies, I need to judge myself. And so when I look at the opportunity, I look at the competitive landscape for RBF financing to other geographies. And so when I look at those other geographies, I fundamentally believe that they're underserved. And so we've decided that that's the cadence, but literally in sort of a 12-month time frame, we're going to, in addition to North America, we're going to open up 3 other geos. And so we're pretty excited about the approach. But yeah, we take a very hard look about, who's serving those markets today, who we can partner with, what's the best way to go about it.
Yeah, fantastic. And SVB has got, puts out its annual Startup Outlook report that has subsections in Asia and the UK and the US and Canada as well. John, what's the, what additional, are there additional 2020 plans that you can, or that you are at liberty to share with us for SVB?
Well, I think what I can't talk about, I think, is our, alignment with Lighter for the Canadian market. We're very excited about the Canadian office being opened. And if you look at the market, there's a vibrant early stage ecosystem up there, and the different lending options are available to startups in that market seem to be, based on our researchers, looking like they're a little bit larger. The credit appetites are looking for a little bit larger, venture-backed. And so it depends on the regions, but the composition of credit as well as the equity providers in those markets changes dramatically, just even in the U.S. and around our offices around the country. So Lighter could have a very large impact on our business up there, in that we are able to come in and, again, stair-step the credit levels, where we can start addressing the very early stage companies with our network, with the different banking services that we can provide into it, with probably larger credit commitments initially, where Lighter can come in and help us make inroads, build valuable relationships, meet credit needs, and again, just kind of replicate what we're trying to do here down in the U.S. We can largely get that right in Canada, and then look at their offices as we have footprints in the UK, in Germany, and in Israel. We're not in Australia yet, but I think there's plenty of work ahead of us as it is right now. But Canada is most likely the next place that we're going to look to kind of push some of the partnership forward.
Yeah, what are the markets that you guys are most excited about in Canada? It's a big country. Everything from Kelowna, that is kind of I consider a sister city to Boulder, to the Greater Toronto region, or Montreal with StartFest. So, what are some markets that you guys are jumping into?
Well, we've been in Canada for a number of years, and we've serviced that out of the our East Coast offices, or up from Seattle into Western Canada. So I'd say we're equally excited about where all the innovation is happening. I think we're right now focused on just where our office locations are, but if we can work with partners to start attracting entrepreneurs into opening accounts with the bank in geographies, particularly in Canada, where we're not, that's even better. And that's really aligns with how we're trying to push our digital initiatives with the company forward, where we can start introducing more valuable digital experiences that are really representative of SVB's value proposition, access to network, innovation, insights, providing access to capital through our VC capital. So largely working with partners like Lighter, which is part of our digital experiences, includes Canada as well as what we're trying to do, yes. But it's early on, so we're really focused in the States and trying to really get a lot of volume going. We're about 12 months into it with Lighter, and so we're continuing to develop the inner workings of the partnership, and continue to figure out what works best in terms of client experience, and also other opportunities for us to just continue to expand the partnership, because there's
great
alignment is significant, so we're just looking at every angle.
Yeah, great, excellent. Well, good guys, this has been fantastic. Before we wrap, what didn't we cover here that you would love to share with our audience?
Well, I would say it's not that we did cover. I would like to expand on one particular thing. We continue to talk about this continuum. It's the basis of the obvious partnership that we continue to outline here. It's a very important concept for early, late stage, whoever, if you're an entrepreneur, you're going to need capital. You're always going to be looking at that situation, trying to figure out the way to, pull that off and which is the right type for the right stage. But I would say, that especially for our listeners that are perhaps earlier in that spectrum, very often you don't even understand that these things are available. So I understand that part of what we're trying to do here today is educate people. But I guess I would argue that, go reach out to Silicon Valley Bank, reach out to Lighter Capital, reach out to your local network, whether it's Techstars and, your organization, Rich, what have you. One of the best ways to understand these concepts is to build your own network. And because all too often I see early stage entrepreneurs that maybe have a great idea and they're either technically oriented or they have some a particular business practice that they understand very well, but they may not understand some of these other capital sources. And, they don't teach that stuff in MBA school either. And so the way you figure it out is to build your own network. And all of us would like to, we're all pretty passionate about helping the entrepreneurs. So go build your network to figure it out.
Love it. Absolutely. Couldn't agree more. John, how about you? What would you like to expand on or share that we didn't get a chance to cover?
Well, I would say that from the founder standpoint, I know we've talked a lot about recurring revenue today, and that's a very natural place to be able to lend at progressively larger amounts. But I'd say, as you're looking at your company, there's ways to maybe view, the cost of capital. And I think just being from early on, being very mindful of, of course, the equity would be the most expensive, and then moving into what is debt capital, which should be progressively cheaper, but come with more trade-offs, right? And need to be repaid. But there's also if you're looking for ways that you could leverage the company, there are assets that companies that particularly may not be recurring revenue could generate invoices or other kinds of assets that could be monetized. So I'd say examine your business. If you have revenue and you have different assets you're creating, look at ways that you can leverage that, whether it's a company that will purchase invoices from you. It's not right for everybody, but I think that there's ways that you could ease into non-dilutive sources of capital at the very early stages. Finding your first invoices are ways that you could monetize that, and then slowly moving into progressively larger credit facilities. Because raising capital often at the very beginning, by virtue of not maybe understanding all the other options available to you, could have a significant impact for how much of the company you have at the very end of the long journey. So I'd say just be aware of there's different ways. As long as you're creating revenue, you should really talk to people, get to know somebody can help you look at all options. That once you turn the corner and you have assets you're creating, you should really explore the lowest cost of financing first in responsible amounts, right? Because you're always going to need to raise equity, but you can reduce the amount of equity you need to with different assets if you can leverage that. And that's just a smart way of engineering your capitalization, because that will impact you on Series A and B onward. It's just orders of magnitude difference. 20 grand means a lot to maybe a startup, but down the road it won't. But I think when you look at how much equity you've given away in the very early days, it could be underappreciated, the cost of that truly. So
yes, definitely in a long-term perspective.
Exactly. So it's not exactly the right answer, but I think just being educated that on your balance sheet is what areas can you generate cash from.
Yeah, excellent. That's great. You got to have something to leverage, whether it's receipts, MRR, assets. Not a lot of assets in the tech world that you can leverage, or because when you're going out to raise venture, if you don't have a product and you don't have customers, you got to leverage your reputation. And if you don't have that yet, then you don't have much to leverage. So, you get the customers, you get the revenue, you can keep the equity, you can get the alternative capital, and then you get to raise on your terms.
Correct.
And those are things that I love to see from entrepreneurs.
Definitely. Thanks so much, Rich. Thank you so much, Thor and John. great insights on alternative capital and all the options that are out there other than venture capital. So very interesting stuff. And I loved how relationships, no matter what you're doing, matter. So Thor, thanks for sharing that as well. All right, we're about at the end of our episode here, but wanted to share one more thing. We couldn't get anywhere we go without our partner in American Airlines, so wanted to share a few words from American. With American Airlines, you can give your company's travel budget a lift. American Airlines Business Extra is a rewards program for companies that can help get the most out of your travel budget. It's free to join with no minimum flight or spend commitments. The more you fly with American Airlines and their partners, the more Business Extra points you earn. Points can be redeemed for round-trip flights, cabin upgrades, Advantage Gold status, Admiral Club memberships or passes, and your employees can continue to earn Advantage miles and your company earns Business Extra points at the same time. It's a win-win. Doesn't your business deserve something extra? Thank you, American Airlines, and thank you, listeners. Hopefully this episode opened your eyes to other options other than venture capital. I'm your host, Frank Gruber. Thanks for listening to the Startup of the Year podcast. Until next time.
Thanks for listening to the Startup of the Year podcast. Be sure to subscribe, and we'll be back with another episode soon.